Good evening, everyone. We are delighted to welcome you to the Fund Managers League session powered by the Private Client Group of Kotak Securities. Before we start the webinar, I would like to introduce Akshay, who leads the product practice at the PCG, to walk you through a small presentation about the Private Client Group. Akshay, over to you.
Thank you, Ketki, and thank you all for joining us. Now, most of you would know us, but for those of you who don't, I'll just take a couple of minutes to talk you through, the private client group and what we do before we start the session with Mr. Mark. I'll just put on the presentation. Yeah. So Kotak Group, as most of you would know, is the largest wealth manager in the country. We manage more than 2.5 lakh crores of assets at this point in time. Kotak Securities, meanwhile, is the fully owned subsidiary of Kotak Mahindra Bank, and we've had a long and successful track record of more than 25 years of managing equity markets as well as products apart from equity markets, which include the mutual funds, bonds, alternatives, and structures. Now, within Kotak Securities, Private Client Group is the vertical which is dedicated to the differentiated needs of high net worth individuals. About the proposition, apart from our deep expertise into direct equity, we also help you protect and grow your wealth with well-diversified portfolio solutions and low-cost offerings like direct mutual funds. We also help you with your banking credit needs, and we also have with us offerings like SLBM, which help you generate returns on idle portfolios. Now, in the direct equity offerings, you have equity baskets which help you generate long and short-term returns. There are derivative strategies which help you generate uncorrelated returns, which work wonderfully well in markets like these. We also bring to you unlisted opportunities from time to time. Apart from that, I spoke to you about SLBM. There are opportunities in arbitrage and buybacks as well, which we keep bringing to you from time to time. I'll just spend a minute to give you a glimpse of our investment process, which begins by identifying your needs and assessing your risk appetite. Once we have enough clarity on that, we always recommend you to diversify through the right asset allocation and find the right product fit for you. Once the portfolio is constructed, we then ensure that there are regular updates and reviews on the same. So asset allocation is something that I spoke to you about. We always ensure that you don't put all your eggs in one basket and you do diversify across asset classes. For those of you who are into trading, we have a very robust platform which is also backed by offerings such as free intraday trading. For a small subscription amount, you can get free intraday trading throughout the year with zero account opening fee and low brokerage on delivery rates. Apart from that, so there are trading platforms on app as well as on terminal. So in terms of our research prowess, it is unquestionable. Top-notch research also helps us take decisions like avoiding credit risk from 2018, which has worked wonderfully well for client portfolios and shifting our stance between equity and debt depending on market conditions. Apart from all of this, on being a part of PCG, you also get access to all our research, client meets, and conferences. And we want this to be a bilateral process where you grow your knowledge and wealth along with us. Apart from all this, in this entire journey, you would have a dedicated relationship manager and a dealer who would handhold you through the entire process. So broadly, that is it from my side. I would hand it over again back to Ketki to introduce Mr. Maran.
Thank you so much, Akshay. That was quite insightful. I would now like to introduce our guest speaker for today, for Mr. Maran Govindasamy, who is the co-founder and the executive director at Unifi Capital, as we all know. Mr. Maran has over 27 years of experience in the capital markets and over 20 years being serving clients with niche investment strategies. His last stint was with Alpic Bank of Bahrain and Kuwait Finance Limited. He currently manages investments for some of Unifi's most important relationships and has also been instrumental in spearheading Unifi's initiatives into niche investment strategies and new geographies. Please join me to welcome Mr. Maran Govindasamy. So we could now start off with the webinar.
Thank you. Thank you very much for the generous introduction. Am I audible?
Yes, sir. Please go ahead.
Okay, thank you. So, thank you very much for taking time out to join this call. Not often we venture out and present the investment proposition of PMS or in specific our themes in contextual terms to macros, global events. So don't worry, I'm not going to bore you with hundreds of slides, take you through all the global events, macro discussions. But over the next hour or so, I'll just take you through broadly 2-3 data points and 2-3 perceptions we carry and the reality. Even though the title of today's call was more oriented towards mid caps, please don't get me wrong, I'm not a mid cap specialist that way. I'm not a small cap specialist, I'm not large cap specialist. We don't specialize in companies based on their market capitalizations. Instead, we focus on those few opportunities that larger managers tend to ignore. And there are no depth of them. And such opportunities don't come all the time. Not that our teams work 365 days a year, all the years. But there are pockets of market where the specific niche segments that we focus, we tend to get opportunities. There are times in market where we don't find many. So our approach to investing and serving investors in Unifi now for 19 years, this is our 20th year, has always been focused on those thematic style of investing, which is agnostic to the size of companies that we invest or the sectors per se. But if you are value conscious, it's natural you tend to get into majorly small caps, mid caps, because large caps very rarely you will find the gaps between the price at which they trade and the value they are worth. So I'll get into the presentation. It won't take, it's hardly 10-12 slides, won't take more than half an hour, but it will be great to spend more time on the Q&A side than the presentation. I'll just get into my slides. 1 minute. Can you see my screen?
We can.
Yeah. Okay. Before we get into the merit demerit of small mid caps, let's first understand what is large, what is mid, what is small. Prior to January 2018, different people had different parameters to describe what is large. If you had asked Goldman Sachs anything below 5 billion, they would have said as small caps. Probably ICC would have considered that as mid caps. And people like Unifi would have considered them as large, same $5 billion company. But our regulator SEBI came and clearly identified, for uniformity's sake, instead of defining large, mid, small as an absolute number, they said first 100 companies are large caps, 101 to 250 as mid caps, 251 to 500 as small caps, and then you have long tail of micro caps. Today, the largest market cap company, that's Reliance, is close to about 11 lakh crores market cap. That's company number 1. And if you go to company number 100, which will be something like MRF, will be about 27,000 crores. And this changes, the value could change daily basis. And this list changes once in a while in few months. The mid caps are company number 101, which obviously starts from 27,000 crores, goes up to company number 250, whose market cap could be about 7,000 crores, almost $1 billion. And company number 251 to company number 500 will be companies in market cap range 7,000 crores to 2,000 crores. And India, in BSE, we may have about 4,000 plus companies. NSE, we have about 1,950 companies trading. And these 500 companies, company number 1 to 500, is obviously 95% of India's market cap. So if you look at these 500 companies, you are as good as looking at 95% of all companies trading in India. This is a slide from ICICI. Actually, the source data is Kotak Research, which is nothing but how the market capitalization of this top 100 large caps, next 150 mid caps, and rest of small micro caps behaved over the last 20 years. You will find different numbers. Actually, the first top 100 companies, that is large cap, market cap, as a percentage of the total market cap of India. Total market cap of India is around $2 trillion. That's about $2,000 billion. And $1 billion is 7,000 crores. We are talking about something like 140 lakh crores, right? So that market cap, 2 trillion, almost 79% of that was top 100 companies in 2003. And if you look at over the last 20 years, in times like 2013, it even went up to 81% of India's market cap were top 100 companies. Last year, it was about 74, and mid caps were about 15% of the market cap of India, and small caps are about 10. This is as of today. 76% of India's market cap are those 100 companies which are large caps. And the next 150 companies, which are mid caps, are about 15% of India's market cap. And the balanced tail, long tail, 250 small caps and micro caps are little less than 10%. So since the top 100 companies themselves constitute more than 3/4 of total market cap, it's natural for institutional investors, both domestic as well as foreign, to focus on this space. These 100 companies in this space, because of the institutional interest, has significant institutional research also. For every company in this list, you can get 10 different reports from 10 different research firms. But these 15% of India's market cap, which are in the 150 mid caps, you will find less amount of research. Some mid caps you may not find any research report at all. And it's even worse in small caps. And it's very natural that less research leads to more information asymmetry, and that in turn leads to more volatility. And the price at which these stocks trade and the value they are worth, the gap will be very wide in small mid caps as compared to large caps. Very wide doesn't mean they trade cheap as compared to the value. In bad markets, they may trade cheap as compared to their value. In bullish markets, they actually trade expensive than what they are truly worth. So if you're a level-headed investor, with good quality primary research, this volatility can be your friend. That way, we find a lot more interesting opportunities in this space, even though that's about 15 plus 9, 25% of our market cap. We are not large fund managers. We manage close to about 4,000 crores across maybe 4 or 5 strategies, and therefore each strategy, our largest fund may be about 1,200 crores, which we invest in 20 stocks, and therefore our ideal ticket size per company may not be more than 50, 60, 70 crores ideally. Some may be more, some may be less. So 50, 60 crores kind of ticket size in a company whose market cap, if you take the median market cap of large cap, as I mentioned, a company number 1 to 100 starts from 11 lakh crores to maybe 25,000 crores, and mid caps will be 25,000 crores to 7,000 crores. And even if I invest in the lower end of the mid caps, 7,000 crore company, 50, 60 crores is less than 1% of the company, and therefore we may not have much pain in entering or exiting. Look at how promoters holding have been. This is important number, very unique to India. You won't find this that much relevant in global context. Because all said and done, the ownership composition of India is promoter driven, even today. As I mentioned, the total market cap of India, if you take, that's about 2 trillion. Few months back it was higher than that, now maybe slightly lower than that, around that range, $2 trillion. And if you take the single largest block of shareholders, promoters would constitute almost about 55%. 55% of listed companies' market cap is owned by promoters. FIs own about 20%. All mutual funds, LIC, private insurance companies, all domestic institutional investors will be about 13%. And you, me, portfolio managers, all put together will be the rest, which is 12. But that percentage differs from size-wise. Maybe the large caps is about 53% of all large caps shares are held by promoters, and 58, 59% is of mid caps are held by the promoters, and 56% of small caps are held by the promoters. This is what I explained, the ownership pattern of India's market capitalization. Promoters are the single largest block of shareholders. FIs are 20%, which is significant, right? 20% of the India is almost about 40% of the free float. FIs own, and therefore their entry exit gets reflected in the way the index moves and gets a lot of media attention. But if you look little closely, where is this 20% of FI investment is invested in? 20% of 2 trillion is close to about 400 billion. Let's say you are the FII and all FI investments in India are done by you. How will your portfolio look like? Almost 1/3 of your money is in 4 stocks: HDFC, HDFC Bank, TCS, RIL. FI investments in these 4 companies is almost 1/3 of total FI investments in India. And Nifty, as you know, has 50 stocks. So after these 4 stocks, if you take the company number 5 to company number 50, that's about 46 companies, that constitute another 50% of the FI investments. So literally 80% of FI investments in India are in Nifty companies, which is precisely the reason FI selling gets dramatic impact on Nifty, and FI buying gets dramatic impact on Nifty, and their impact on non-Nifty stocks, more in mid cap and small cap, is not that dominant. But when we say FIs, we we call everyone as FIs, but there are all kinds of FIs. You have private equity funds, you have sovereign funds, you have pension funds, global mutual funds, aggregators, and hedge funds. The last 1-2 category may be short-term traders. The first 1-2 category are really, really long-term. There are several FIs who own stocks in HDFC, HDFC Bank, TCS, RIL for 10 plus years, 15 plus years, for long periods. And there are FIs under this hedge funds category who may even take speculative positions, trade short term. This is ever since the small cap, mid cap index was built by BSE from 1st April 2003. This is how they have moved. You find three colored lines. The blue line is Sensex, large cap, and the red line is mid caps, and the green line is small caps. It doesn't need any great expertise. We all know that. The graph just validate what we already know. In a rising market, mid caps red line rises much more than large caps blue line. And in a rising market, small caps green line even moves further better than mid caps. But in a falling market, mid caps fall more than large, small caps fall even more. The subsequent rise, they rise more, subsequent fall, they fall more, rise more, fall. This is a usual pattern. Two observations I will make now, and I will come back to this graph maybe towards the end. The first is, in a rising market, we all know small mid caps rise more. Between 2003 and 2007, Sensex went up 100 to maybe 700, 7 times. 3,000 index went to 20,000 Sensex. But when Sensex went up 7 times, mid caps went up almost 11 times. Small caps went up 15 times. But all of those gains, they lost in 2008. But if you are a type of investor who always invests in small mid caps, you will have this extreme volatility. If you're an investor who always invests in large caps, you will have less volatility. But worse will be those investors who may not start in 2003, but they see markets doing well in 4, in 5, and they start with the large cap. Then they see mid caps doing well. Then they shift to red line. Then they see small caps doing well. Then they shift to green line. And in a rising market, they make large cap kind of rise, but in a falling market, they will make small cap kind of fall, which precisely is the reason why majority of investors' experience in small mid caps are not that great, because they would have come closer to the peak and they regret their decision closer to the bottom. And many of these are counterintuitive. And therefore, if you stick the course, your returns could be decent. Over the same period, if you actually look at large caps have done close to about 13 and a half, excluding dividends. And small mid caps would have done 15, 16 and a half kind of percent. But the standard deviation of small mid caps could be maybe a little more than double of large caps. That's one observation. The second observation is all these lines, valuations, converge in panics. Prior to 2003, when small mid cap index was built, some of you who have been investing for longer period may remember 2001 was an extremely painful period when you had September 11 attack, IT meltdown, Nasdaq crash, Katan Parik scam. Those are the days when Government of India used to borrow, GSEC yields were around 14-15%. And AAA corporates used to borrow at about 20%. Cost of capital was so high, and therefore there was no incentive for investing in equities. And Sensex declined almost about 65% in 2001. And there are many stocks in certain sectors like IT, which fell 80-90%. And when those valuations converged in September 2001, it took almost 1.5 years to bounce back. And the bounce back started from 2003. Same way when we had 2008 financial crisis, all the lines converged in May, June 2008 after Bear Stearns default prior to Lehman crisis. And the bounce back started from May 2009 when Congress government second term came in and market started shooting up. Again, they converged in 2013 which was not anything to do with global events. It's more India-centric. And that time, you might have seen our rupee lost almost about 15-20% in short periods. Our central government fiscal deficit crossed 6%. And there are all kinds of default fears on Greece, Spain, Italy. And India had its issues, current account deficits, fiscal deficits, all that. And oil also almost crossed $100. And that pain got reflected and small mid caps converged with large. And then it took almost about 8-9 months before 2014 election and market bounced back. The beauty is 23rd March 2020, all the lines converged again. The thought which I would like to leave with in this slide before I come back to the same slide, maybe towards the end, is each time there is a convergence, the bounce back here in 2001 to 3 could have taken 1.5 years. In 2008, would have taken maybe 9 months. In 2013-14 would have taken maybe 6-7 months. But each time the convergence occurred, the bounce back was sharp where? It was sharp in small mid caps than in large caps. But the perception most of us carry is large caps lead the rally. At least the data points don't show that. But the impression people carry is the small mid, when people look at index and therefore conclude a portfolio would have done somewhat similar to index, and everyone measures each portfolio or each stock based on how much they have done better than index. These lines may require some explanation for you to understand, but it's not too complex. It's very, very simple. The line graph is Sensex, and the first box is 2017-18, second box is 2017-19, 2 years, and this is 3 years. Let's focus only on this. So effectively, in the last 3 years, index moved almost about this left-hand side to be seen with BSE Sensex, right-hand side is to be seen with stock returns. Each dot is each Sensex company's actual return, and this line is Sensex. So to an outsider, when they say that last year Sensex went up 10%, the impression they carry is most of the Sensex stocks would have moved around 10%. In reality, last 3 years, Sensex has given more or less no return. In between, it went up almost about 50-60%, and they lost all of it. And now they are back to where they were in May 2007. But during this period when Sensex has moved nowhere, there is one Sensex company which has moved two companies which have moved little more than 100%. There are about 5 companies which have moved between 50 to 100%. And there are another 5 companies which have moved 0 to 50%. And there are maybe 10 companies which have fallen between 0 to 50%. But there are 2 large caps which have fallen almost 80-90%, all in the same period. So combination of all these dots is this line graph. So when index moved 50% and then went down, and net index has moved nowhere in the last 3 years, you have 2 Sensex companies up 100, 2 Sensex companies almost close to minus 90, 100. And the rest of the stocks are anywhere between minus 80 to plus 60. And there is no Sensex company which is close to 0. This is what is called stock level divergences from the index. And these divergences are more in 3-year period than in 1-year period, which means stocks begin to diverge within the index based on what? Based on performance of that company. Just because a stock is in Sensex doesn't mean that stock also will move along with Sensex. If the company's earnings are growing, PE multiples are expanding, they would have grown much more than index. On the other hand, even if it is a Sensex stock which has declining earnings, it may not show up in 1 year, but it will truly show up in 3 years. Over a long period of time, as a shareholder in a company, whether it is Sensex company or mid cap or small cap, all you make is what the company's earnings are, but it's over a long period of time. But in the daily basis, monthly basis, you may find a lot of correlation between stock returns and the index. but over a long period of time, the stocks diverge away. This is Sensex. This is mid caps. And the divergences are not 50-60%. Here you may find companies even between, there are 10 companies in mid cap index in the same 3-year time period, which would have given 100, 200. There are several of these mid caps which are given minus 70, 80. But index has shown only about minus 20. The divergences are more in mid caps than in large caps. This is how small cap index has moved in the last 3 years. And this is how individual small caps have moved in the same period, last 3 years. So had you bought some of these large caps 3 years back and sold now, there are about 40-50 companies where your returns would have been 100, 200, 300%. There are maybe 60-70 companies where your returns would have been between 0 to 50%, even though index was net negative. But there will be hundreds of companies where your returns would have been minus 30, minus 40, minus 50. And combination of all these lines are what is index. The divergences are more in small caps than in mid caps, which leads us to one simple observation. If you don't know what you are buying, by buying large caps, the chances to go wrong could be less, but the chances to do dramatically better is also less because the divergences are not that much. But if you know what you are doing and you have a rational mind, you can be a contrarian and you stick to the values, then you will make more money where the divergences are more, which is small mid caps. That's all this line says. And therefore, if you commit mistakes in stock picking and markets can punish dramatically here, many of these small caps, when they get punished and the company performance becomes poor, they may not be alive to come back in the next cycle. So the default risks, chances of going wrong are much more in small mid caps, which leads us to the point that it requires a reasonable amount of sophistication in small mid cap because chances of going wrong are a lot more. Which is what I was highlighting, say at the end of the day, a price, whether it is long term, short term, whether it is large cap, mid cap, small cap. The price has only two variables, earnings and PE multiple. So between yesterday and today, the price moved 2-3%, not because the earnings of the companies moved, but the PE multiple has moved. Over a long period of time, PE multiple alone doesn't move. PE multiple is a cycle which is a function of market cycle, which is what people refer to. Earnings is more with a business cycle. The business cycle doesn't change every quarter. It takes, business cycle is a cycle, but 3-4 years, a business does well, 2-3 years it do badly, but those business cycles are much longer. The market cycles could be, March could be one cycle and May could be a different cycle. So predicting price through PE multiple requires some understanding of market, mood, sentiment, demand, supply, FI, interest, all those things. But predicting price through earnings point of view requires strong understanding of the company, the customers, vendors, suppliers, competition. If you look around, most successful investors who built significant wealth over a long periods of time, you notice that most of their wealth would have come from maybe 5, maybe 8, maybe 10 investments they made, which they held for a long period of time. And if you take the company's shareholder returns, most of that would have come from earnings, right? PE also expands, but PE follows earnings. Earnings don't follow PE multiple. If a company's earnings keep growing over a consistent long periods, PE multiple could expand. But just because PE multiple is expanding doesn't mean the earnings grow. So there are two variables which drive price, but one is following the other one. It is important for us to focus on the first one. And that earning cycle, if it is going to be more volatile in small mid caps, that leads to much more volatility in price. And that's where people like us find opportunities. This is something which I find it hard to explain, even though it's very simple to explain. Maybe the ease with which we can explain to an investor is inversely proportional to the investor's sophistication looks like. Small caps, people confuse with small companies. Small caps need not have to be small companies. What is small cap? Company number 251 to 500. But majority of these small caps that at least we have been investing and we have been tracking are number one in their business in India. They may be the largest players in that business, but they are small caps. Maybe because that business itself is not very large, or that business may be extremely fragmented where there are lots of people and the largest player still could be doing maybe 2,000, 3,000, 5,000 crores kind of top line. They're called small caps. If only there are few businesses like financial services, IT, automobile, oil and gas, where you may find not even oil and gas, maybe automobiles, IT, financial services, where you find small cap, mid cap, as well as large caps. And investors have a choice to choose small, mid versus large in those businesses. But if you take a business like, say, oil and gas, there are only large caps. There are not too many small, mid caps out there. Telecom, only large cap. But if you take, say, specialty chemicals, that's, by the way, is largest part of our portfolio. You won't find the largest specialty chemical company in India, even though it's a $30 billion industry, which is close to 2 lakh crores industry. The largest company itself is not a large cap. There's no large cap in specialty chemicals. There are only small mid caps. Nowadays, people talk so much about diagnostic services, all this. The largest diagnostic services company will still be a small mid cap. There are many items in consumption. Maybe soap, shampoo, toothpaste kind of market's largest company may be a large cap. But if you take, say, footwear industry, the largest company can still be a small mid cap. So such companies need not have to be positioned as small companies. Within the business they operate, they may be leaders. So large caps are not leaders. Small caps are not small companies. Even though it's very simple, but it is very important to bear it in mind, because many times we confuse. Quite often I have been asked this question. Markets are terrible, economy is not great, how will small companies survive? Actually, many of the small companies that we own, at least 8 out of 10 of them are zero debt in balance sheet, number one in their business, and they are in a formidable position than many of the large caps today in India, right? So let's not confuse small mid caps with small companies. It's the leaders in business can still be small mid cap, and you may find some large caps which may not be leader in their business, because that business may be extremely. There may be 5, 6, 7 players, and there will be even bigger guys within the large cap space or unlisted space or outside India space. So the line that the same graph I'm coming back to is only one reason. Now that the convergence have happened, and if you are, we don't know whether the divergence, the market movement, maybe in hindsight we'll know whether we are already in that V-shaped, U-shaped kind of recovery. But it has taken 7, 8 months in 2013. It has taken almost 9, 10 months in 2008. And it has taken 18 months in 2001 to 2003. I don't know whether it is going to take how long this time. But one thing is clear. It is not that the bounce back is going to be sharp in blue line. It's going to be a lot more sharper in red and green line. But that's not going to move in one uniform direction. Actually, yesterday, there was a small news where I was reading that there are about 100 plus companies which have reached 52-week high. Market is not at 52-week high. We are still 20% lower than where we were 3 months back. Although we have bounced back from the bottom, but from the peak, we are still at least 15% to 20% away. But there are hundreds of stocks which are at 52-week high. And if you look closely, most of them are small mid caps. So that bounce back, when it happens, will be sharp and they are very volatile. So it's very important to be very objective on the kind of companies we hold, rather than narrow focus into one broad definition of whether they are large caps or mid caps or small caps. I also touched upon the fact that the promoters are the dominant shareholding class, And it's very important to observe what they are doing in the stock. It's a myth among investors to look at promoters holding as a constant number. It will look like it is 53% large cap, 59 in mid cap, 56 in small, and it looked like it was 54 last year, 57 this year. But those few 3 percentages are significant in rupee. And these promoters, because they are dominant shareholding class in India, more than half of them, more than half of the shareholding in India is held by them, which is 55% today. When do they dilute? When do they buy? They're greatest contrarians in India. So this line graph that you see is how mid caps have moved. And each bar is the number of companies where promoters have increased stake. So let's say you are a promoter of a company. When do you dilute your stake from 100% to 75? When do you list? When markets do well, when valuations are attractive, when your sector is fancied by the market, when your company is doing well, you appoint investment bankers, buy media, do roadshows, and bunch all the good news, and then do a dilution at a highest price possible. Which means when the markets do well, you will find a lot of IPOs. How many IPOs in 2007? When market went up 7 times in the last 4 or 5 years, there are hundreds of IPOs. How many IPOs in 2017? When last time when he had mid-cap peak, you had more than 1 IPO per week, more than 50 IPOs that year. But how many IPOs say last 6 months? Hardly any, right? On the other hand, how many companies promoters increased stake when markets kept going up in 14, 15, 16? If you actually look back, 2014, after the elections, when our Prime Minister Modi ji came in, just after that, 15, 16, 17, those 3 years, the total capital that came into mutual fund stroke PMS was more than the total capital investors invested in the previous 20 years. I'm repeating. Between 1995 to 2014, the total capital raised by mutual funds from all investors across all equity schemes was less than the total money they raised in 15, 16, 17. So when such large capital came and markets were running up, you found less and less promoters increasing stake, and you found many and more companies coming with IPOs, dilutions, QIBs. And last March, when market tanked, of course FII sold. Domestic institutions made token purchases. They made, of course, purchases, but had they bought as much as what FII sold, market should not have fallen. One selling, one buying, equal value, that's gone. But most of the FII selling happened in Nifty stocks, and not necessarily all promoter buying happened in Nifty stocks. Promoter buying was widespread. And that buying, the number of companies that promoters had increased stake in March 2020 is almost a 11-year high. And that inverse correlation always exists. Even in 2008, when Sensex fell from 20,000 in January to almost below 8,000 in October, and after a 60% fall, the whole world was in paralysis. Mutual funds were selling because their unit holders were redeeming, and the biggest buyers were promoters, and they turned out well. And if someone had just followed promoter buying, it's not that all companies where promoter stake increase actually do well. 11% of the companies where promoter stake goes up don't do well even after 3 years. So it's not that each company, therefore, their promoter stake goes up should do well. But collectively, if you see, the pattern is very visible. And the buying when promoter buys is a good tool to measure the market expensive valuations. Where are they expensive for the large sophisticated investor to buy? Because they act in a time like March 2020 because they don't buy their own stock and evaluate whether they have done better than benchmark, whether it will go 3 months later, 6 months later. They buy when it makes sense. If 100 rupees worth of shares is trading at 50, they buy. And if it goes to 40, they don't consider their decision of buying at 50 as wrong, doing mark to market. So that comfort that they get from the control they have in the company and the long-term outlook, if they have been running this company 5, 10, 15, 20 years and they are likely to run that longer, that long-term outlook enables them to be a contrarian. And it makes sense for us to observe this to decide whether the valuations are favorable from investors, long-term investors' point of view. That doesn't mean when they buy, it immediately bounces back. There are many times where they keep buying, like in 2011-12, as prices fell, they kept buying, but the prices continued to fall, they kept buying. But investors like us, when we see the price fall and we buy, and if the price continues to fall, we may even start doubting our own stocks. So that way, I think this is one other extremely important data point, which gives you certain insight on whether the valuations are attractive enough for reasonably sophisticated investors to buy. So to sum up, the whole point I'm trying to communicate only two. One is whether it is small, mid, large, when the valuation convergence happens, when the bounce back happens, it happens in a very short period and it is very sharp. And people who say last 1 month, 2 month rally is very sharp, go back and look at it. This small line that you see between 2003, April and September 2003, that small line is about 150% after the 2001-2 fall. After 2008 fall, the subsequent 8 months, small cap, mid cap return was close to about 130%. Even large cap moved up almost about 40-50%. So when the valuations convergence happen, the bounce back, whether it takes 3 months or 9 months or 1.5 years, the bounce back will always be very, very sharp, and it happens in a short period of time. And timing that is not a skill set that I have and not that I wish to have. But what skill set we need to have for us to do well in especially small mid caps is what are you buying is more important than when are you buying, and what are you buying is equally important along with what valuations you buy. And those are two things that we focus. There's no one unified tracking markets daily basis or global macros or take those kind of 360-degree holistic view. But in those small niche pockets of market that we focus our attention, we tend to make our investments more based on the companies and the businesses that we buy, not define that. There are teams on which we manage. I was just talking with the Kotak team before this call started. And if you take all the clients which we serve in Kotak, our largest fund, which is called Blend, even current year, beginning from January till date, they are still in positive zone. There's no derivatives, there is no exotic structures. These are all small mid caps dominated portfolio. But the companies that we have held, even the trailing 12 months, the earnings have not been impacted. The earnings have actually grown. And the majority of the companies, maybe 80% of the companies we own are zero debt and strong balance sheet. And therefore, they're not impacted. No one is doubting their ability to survive. But at times like this, where COVID situation, very fluid, and we don't know how much impact this is going to have on which sectors and how long. But one thing is clear, that while we don't know the size of impact in sector-wise and period-wise, the working capital cycles are getting stretched. More than the cost of capital, the availability of capital is very asymmetric. And at times like this, if you are a zero debt company in a business where you are surrounded by people who have leverage, then it puts in a great, uniquely advantageous position. When everyone is looking at GDP growing down -5, business volumes going down from 100 to 90 or 80, what they are not noticing is number of players in the industry also coming from 100 to 60 or 50. And if you are buying owners of equity in a company which actually survives, they usually gain market share. We even came out with which is today our second largest fund, called Business Consolidation After Disruption. And essentially small mid caps, but almost 14 out of 18 companies we hold may be small mid caps, but they are number one in India in the business they operate. And those companies actually could weather storm at times like this. There's no deterioration in the portfolio value whatsoever because we don't own any private banks. We don't own IT or automobiles or oil and gas, even though these four constitute almost more than 2/3 of Sensex and Nifty. So if our portfolio composition and the industry composition are completely different, why should we move like index? Our mandate is not to create alpha or beta or outperformance. Our mandate is to look for a decent long-term return that should come from earnings growth of the companies. As long as the earnings profile of these companies are strong and visible, we choose them to buy and hold on. And we don't therefore necessarily build our portfolio based on sectors, and which is how specialty chemicals and pharma turned out to be significant overweight even before COVID. And we completely avoided most of the credit-related firms because valuations were not in favor even last year. And therefore, this year, we have been extremely pleased with the way the portfolio performed and weathered the last 3 months, 6 months market volatility, where even the leaders had to go for significant volatility. They're somehow able to keep in the positive zone, even if you take from 1st January 2020 till date, or even if you take the last 1 year picture. Going ahead, whether it is thematic investing or different style of investing, focus should be on the companies we buy and the price at which we buy and the valuations. And where the valuations are more attractive is obviously in the so-called small mid-cap space, not necessarily in the index moving heavyweight names. So that's my presentation. Happy to take questions here. Thank you.
So a couple of questions are there that we have received live. So may I ask those questions?
Yeah, please go ahead.
Sure. So first one was, regarding your philosophy. So people wanted to understand if, there's a filtration criteria which you use to, start identifying those companies, and, is there an investment thesis that you use while identifying these companies?
Yeah, there are 2 types of filters we go. None of our teams are open 365 days a year, all the 5, 10, 15, 20 years. Because here the mandate is not to do better than index. So it is not all weather schemes. We have done about 9 strategies in the last 20 years. And there are strategies like the one that I explained. This business consolidation after disruption is a theme that we worked out post GST implementation, when there are a lot of discussions in market about how GST is likely to be disruptive, especially in the unorganized sector. But this disruption doesn't come only from GST kind of event. Demonetization is a disruptor. RERA is a disruptor in real estate. If you take our own industry, say broking, wealth management, the regulations is a disruptor, and the technology is a disruptor. Today, more than half of the daily trading in stock exchanges is being done by 10 broking firms, which was not the case 10, 20 years back, when we used to have hundreds of broking firms. So the disruption could come in many forms, in many ways, in many sectors. And usually in India, what happens is when one business opens up, you find hundreds of guys jumping in. Few do it well, and those few gain market share and gain scale of economics, and which they offer to customers, and therefore gain additional customers. And then slowly regulations will come in there. Larger guys are better equipped to follow the regulations, and therefore they tend to gain market share. And small guys either get acquired or just leave the industry. So these business consolidations take maybe 10 years, 15 years in certain businesses, could take longer in few other businesses. But the signs of that shift, when it is obvious, the price starts moving and the earnings begin to show up. And if you find, say, top 100 wealth creators today in India, maybe 60, 70 will fall into this category. Whether it is Asian Paints kind of name, Page Industries kind of name, or a Titan kind of name. These are all companies which are leaders in businesses which were extremely fragmented. And during this last 10 years, the business got consolidated. Today, maybe 28% of jewelry industry is consolidated, is in organized. And there has been a shift happening from unorganized to organized, and these companies benefit from it. So we do our stock picking mostly on thematic side. Before we raise money, before we start launching the team, we would have spent years of work in getting that framework. And once we get that framework, we don't style digress. And all the capital we raise in that team, we invest only in ideas within that team. So that's the first filter is on the merit of the team, which is where I think 60-70% of our work goes in evaluating the merit of the team. But once we get in, individual stocks that we buy should be a function of primary research we make. We are a team of about 74 people, 12 in research. For a firm with just 4,000 crores, 12 people in research may sound very high, but the kind of research we do, both on thematic line and the quality of research you have to do on these kind of companies, which doesn't have institutional coverage. If you're a company which already is being tracked by 10 analysts, the amount of time that goes in evaluating could be reasonably less, because the company would already underwent the process, know that what kind of data points the analysts need, and you can always stand on another analyst's shoulders and see it slightly better. But when you do primary research, where the company is not necessarily on wide coverage, there may be 1-2 analyst coverage, but the quality of that analyst coverage may not be that great, which is why the price value gap that exists that we could find. But you need to validate. You need to go meet the companies, visit the plant, know their customers, vendors, suppliers, competition. And it takes a long time, sometimes 3-6 months per company, sometimes even longer. And that's why in India, the cost of research is inversely proportional to the size of the company. The cost of research will be reasonably less in a large cap. You can sit in a 100 square feet office and do research on some of the top 50, 100 names. But doing that kind of research in the company number 200, 300 could be suicidal, and which requires a lot of primary research. So both kinds of filters that we follow. We don't do exotic modeling. We don't look beyond 2 years. Most of our hypotheses should be validated with current or next year performance. And therefore, the merit of theme, for example, business consolidation, I won't go and buy stock where I'm speculating on future consolidations. The process of consolidation should already be happening. It should be evident in our eyes by doing primary research. So that kind of commonsensical research, which stands valid for a 3, 5, 8-year outlook, is more important on our stock picking. We don't worry much about last 1 quarter, next 1 quarter balance sheet or current year stated earnings numbers. So that way, I think this approach is more of a value investing approach, but without compromising on the growth. And since we operate in this niche space, it is not crowded. Here you don't have hundreds of institutions fighting with us to identify for values. We are up against retail, small scale fund managers who may not have 74-member team or a 10-11 crores research budget to do primary research, and that's been an advantage for people like us. Yes, Akshay.
Sure. Thank you, sir. So another question is, with the interest rates, what we've seen is that the interest rates are down. Now, will it translate into spending on Capex by corporates? As what we have seen is that the government does not have enough to spend at this point because they have their own fiscal restraints. So do you think with interest rates coming down, it will eventually translate into Capex spending, or it would again be a function of transmission from financial institutions into the other parties?
Yeah. Many times we do narrow framing. In economics, it doesn't work. For example, interest rates coming down should make entrepreneurs more competitive and build Capex. All else being equal, that assessment is right. But in Indian context, at this point of time, there's no need to do Capex. For example, between 2008 and 2014, the private Capex actually singularly contributed to the GDP growth, much more than government Capex, right? You take power, cement, textile, any business, the capacity that went up. If you take 1947 when we got independence till 2005, whatever power capacity we just built in the next 7 years, right? The cement capacity, whatever capacity we built from 1947 till 2007, we built in the next 6 years. And what is the capacity utilization of corporate India? Take last year, it's hardly 74-75%. Reserve Bank of India does every quarter the capacity utilization survey, and it publishes. You don't need any password. You can just Google it and see it quarter on quarter how that number is growing. If you are let's say you and me own all the 50 nifty companies and all their capacities, and all these capacities that we put in 2008 to 2014 is still not yet fully utilized, where is the incentive for us to go and do a Capex? So the Capex not happening last 3 years by private sector has nothing to do with cost of capital. It's to do with the utilization of the existing capacity. If all our existing capacity is fully utilized, then it is natural. You can bet on the Indian promoters increasing capacity is independent of the capital cost. So I don't think interest rates coming down will make the private sector to do significant capex, and that will trigger the GDP growth. That was 10-15-year-old assessment. Today, 60% of GDP growth in India coming actually from private consumption. And that consumption is driven by demography, the income level, the urbanization. There are many other factors to it. And there are growth factors which will drive that. Not necessarily it has to be from Capex point of view. Yes, Akshay.
Got it, sir. Thank you. Sir, another question, you would have received a lot of such questions of, within the BFSI space. So are there pockets within the space you would pick, and are there pockets that you would be wary of at this point in time?
We've been wary of this space for a long time. And for a brief while, we looked like fools in 2018-19 when we didn't have a single private bank. We didn't have a single regular credit finance company. There are two pockets in BFSI space that we were keen. One was in the gold finance side, which has done reasonably well. That was our largest position in our portfolio, not now, for the last 1.5 years, 2 years. The other space that we were keen is in the brokerage space. There are not too many listed companies. People often look at brokerage as an extension of the market valuation. When prices decline, the brokerage revenue decline, the brokerage business decline. But if you actually see only these declines, the brokerage industry consolidates. The larger brokers actually gain market share. And you would have seen that. I'm sure in Kotak Securities also you would have seen. Your volumes actually would have gone up. There is one listed brokerage company which announced in the con call that from 1st January till date, on an average, they acquired 1,000 clients per day. It is not that there are 1,000 new investors coming and signing with just one broking firm. It is just that these guys who otherwise have been dealing with marginal, small, regional brokers choose to deal with the larger players. And those kind of pockets in the listed space are very, very interesting. But last year, when our GDP growth fell from 7 to 4, 4.2%, it's not that whole of India grew 4.2%. About 34-35% of our GDP drivers come from MSME, and that segment last year actually had grown -7. And if you are a private bank or NBFC who have been extending credit, you have exposure to that segment, the pain is actually not yet very clear. Some section of the market is speculating that pain could be severe. Some section of the market feel that that pain could be there for a quarter or two, then it should come back, but it's very fluid. And we have been avoiding that sector, and we will continue to avoid that for a while, even if it means that we are going to miss out few opportunities, because these are all businesses where the reasonably good quality ones are super expensive, and the ones which are cheap for good reasons. So we don't have a good risk return payoff in that space. Yes, actually.
Great, sir. Sir, another question is that, there is a view in some investors' mind at this point in time that, the big will continue becoming bigger, like the consolidation that we have seen in the telecom space. So do you see that as a theme playing out going ahead as well, across sectors? Is that something that will keep happening because the access to capital would be scarce, or, there would be new players emerging out as well?
See, it's nothing new. It has been like this always. So commonsensical. Only in controlled environment where you limit the growth or you put a regulation which incentivizes the fragmentation, big will not grow. But otherwise, in normal situations, leaders always grow. But the big and leaders are two different numbers. For example, let's say I'm India's largest steel company. Okay? But steel is a freely global commodity. Right? But I'm not the largest player in the world. Will I keep growing? I won't. I mean, I have to. What is my shareholder return? Nothing. Zero. Negative. But if I am largest leader in a business which is India-centric, domestic, consumer-oriented item, and that business is growing, maybe 6-7%. And if I have scale of economics benefit which cannot be matched with a small player. At times of stress, that small player may not be able to withstand, he may not be able to retain talent, he may not be able to access credit. But I can give from 1 month extension, even 3 months extension, I can keep paying the migrant laborers even 2-3 months salary so that I can retain. Some of the small guys cannot retain. So business consolidation is a natural exercise. It's nothing new. Investor fanciness for that kind of logic has gained new fanciness maybe in the last 1-2 years. But that's where I highlighted the leader doesn't mean large caps. Large cap doesn't mean leaders. We confuse these two. The leaders will tend to grow at times of distress, but that's how India always has been. See, for example, today 80% of two-wheeler industry is 3 companies, right? 72% of the banking industry is 5 banks. We seem to have several IT companies, but if you look closely, top 5 IT companies do 54% of India's total IT exports, right? So maybe top 5 oil and gas companies will be 95% of the industry. But that's not how it was 5, 10, 20 years back. When I began my career in 1991, there were 1,300 brokers in Bombay Stock Exchange, right? Today, maybe 60 brokers are active, right? There were 20 two-wheeler companies in India in 1991, 20 different names, right? Today we have 3, which is about 80% of the industry. It takes, but what is not sure is maybe say cement industry. Today the top 5 cement companies 70% of the industry, but the top 5 market share 20 years back was not 70. It was not even 50. It was not even 40. It was extremely fragmented. There were some 20, 30 listed small cap cement stocks from just 2 states like in Tamil Nadu, Andhra Pradesh, and all got either acquired or delisted or went out of the industry. So the leaders continue to grow market share. There could be some disruptor who can come from an organization, become leader. But in general leader, for example, a broking industry, there is someone who is not in the top 10, top 20, top 30, who came and disrupted the industry and became number 1 or number 2. That disruptor also becomes leader, and after he becomes a leader, we'll also keep growing like that. So this exists, but the only challenge is when the leader will continue to gain market share, become even bigger, should not be confused with the large caps, number 1. Number 2, when the transition becomes very obvious, if it becomes more obvious in your eyes, more obvious in my eyes, more obvious with every shareholder's eyes, the seller won't sell cheap. And you will then need to pay 50, 60, 70 P. And growth at any price is not good for valuation wise for investors. And many times we have learned this history, even in 2003 to 2007 in Hindustan Lever, even in 2014 to 2019 in names like ITC. When valuation excesses happen, the problem with high PE is not high PE. The problem with high PE is the sustainability of the E. When you already pay high PE, and that high PE will remain high PE as long as the earnings growth is good. And the moment the earnings growth has some kind of slowdown with volume decline, for whatever reason, that high PE will start correcting very fast. And that's a risk if someone is willing to take, by all means fine, but we certainly don't want to take those risks. So can you get into those scenarios where this consolidation is not very evident in everyone's eye, is in some phase of growth, where I may run the risk of getting in little ahead of time, but in exchange I get a favorable valuation. That's the risk which we are finding it interesting to take at this level of market, which is why even though we have zero debt companies, number 1 players in their business, and high return on equity, the PE multiple that we are paying is very close to the rate at which their earnings are growing. So there's no expensive valuations here. So unlikely we will be hurt at times like last 3 months, 6 months is a good validation. The market fall 20, 30% and you don't fall, not because of anything other than valuations and the strong strength in the underlying business. Yes, Akshay.
Great. So just one last question. So a few people have asked this, regarding the recent rally. So people have queries, if this is a relief rally and should we expect Nifty to, go back to sub 8,000 levels? And, do you believe that the worst is behind us, or do you expect that there would be volatility going ahead as well?
To be very honest with you, most of I don't predict markets. That's the easiest way to lose whatever little credibility you have.
Yeah,
So,
agreed.
we don't do that.
Yeah.
But the broad framework we will have. Some of you can see there is one video I did on 23rd March. We put that in YouTube. Usually I don't put my videos in Unifi YouTube page without passwords or anything. This is public view. It's titled Signal versus Noise. And there are 2 slides there which we used on 23rd March 2020 Sensex Nifty valuation along with 2008 valuation to conclude that 7,500 or below 8,000 Nifty is something which is as good as the lowest point of 2008, both by price to book value or price to earnings or what type of earnings. So all valuation parameters you apply, I don't think we will retest the lows of March 23rd, 2020. Having said that, are we going for a V-shaped recovery? By buying now, we will be 20% up next year and we will never go down at all? Unlikely. I think index level, you are likely to see significant volatility. But individual business-wise, you will find the divergences growing and therefore resulting in index level individual volatility. The people even reasonably sophisticated investors who have long history, long experience are beginning to narrow focus, because today in India, if you take our 2 trillion market cap, the top 4 stocks are 20% of market cap, and Nifty 50 stocks are 2/3 of market cap. 65% of India's market cap are just 50 companies, and that's where their attention is going to. But if you look in the broader market, there are significant opportunities even today where you can buy leaders, top quality names at very favorable price. And that kind of stock picking actually don't need a serious stand to take on index directions. Maybe if you're a short-term trader or a speculator or derivatives or index-oriented people, but you may not get any great help from that point of view, any insight from us. But if you're an investor, should you invest all out tomorrow, or can you spread over the next 2-3 months? Maybe it's a good logic to spread, because when we don't know exact precise levels, it's better to spread. But I don't think we are going to have a dramatically lower entry level by waiting out. If you are getting in today to get say a 20-25% IRR over the next 3-5 years, that if you convert in rupee terms, 100 becoming 200, 300, how does it matter whether you enter 100 or 110 or 90? So I don't think index movement can be anything more than 10-20%. But few people consider a 20%, 10% decline as a sharp decline. In our case, I have no signs to predict those kind of 10-15%, 20% movements. When you take a 3-5 year outlook, I think we are very close to interesting buying level rather than endlessly waiting out. That's my answer.
Great. So actually, that's all the questions that we have. Thank you for that. Katie, over to you.
Thank you so much, sir, for such an in-depth session. We all enjoyed listening to your views on mid-cap investing. On behalf of our participants in Kotak Securities, I thank you for taking time and sharing your insights with us. I would also like to thank all the participants for joining with us today. Thank you so much.
Thank you, Akshay, for organizing it. Thank you, everyone in your team, making it live. Thank you very much.
Thank you for your time.
Thank you.